welcome to your Monday Futures Market Outlook for July 5th, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles that we've gone through. We were looking for a second quarter market consolidation to head down towards that 80-week moving average and find lows somewhere in there. We've met the minimum requirement of that and very quickly find ourselves right back to the top end of this range. Now, we certainly cannot rule out the possibility of another consolidation lower this summer, but overall, if the correction plays out in a shallow way like it is right now, it may result in a bullish second half of the year. Just to review our key intermarket observations, the primary trend of the market remains bullish. We were looking for that second quarter correction, and even if there is another leg lower this summer, so long as all the price action remains above the 1200 level in any corrective waves, we should see a bullish second half of the year. The biggest variable, of course, is going to now be in the third quarter will be the US dollar. If the US dollar breaks down again and begins another leg lower, then that would result in a return to a bullish commodity market environment, while it would be bullish stocks and then subsequently bearish bonds. Those scenarios all could be the theme of the third quarter, but as you'll see in the next few charts, that the US dollar has still yet to show its hand. I want to start off here by looking at the daily chart of that S&P 500, and we were talking about a short-term bottom potentially coming in at this 1250, 1260 level. We marked off that blue box as the area where we anticipated the first leg of this correction to come down. The rally that followed has been very strong, and very quickly we find ourselves right back towards the 1340 area, wiping out much of the damage that was done. While at some point here it'll be very healthy for us to have some sort of a retracement or a consolidation, particularly going into the jobs number this Friday. Overall, if the market can hold into these gains, we could see a full retest of the previous highs over the next week or two. The one thing that we don't want to rule out is a possibility that after a week or two consolidation up here, the market still actually comes back for a retest of all of these lows and really bangs out a proper low for the summer. I don't want to necessarily get into the camp where suddenly we saw a June bottom, and then for the next 6 months of July till January, we're going to see nothing but a straight line move higher. I don't necessarily believe that that will be the case, and therefore the overhead resistance levels that we see up here should play a significant role over the next week or two. When we take a look at that US dollar, you can see that the sort of sideways flagging formation is sort of developing for what could end up being a bearish breakdown. The one thing we know is that the bulls have now had a better part of 2 months to try to get the US dollar to remain and gain some sort of strength, and that came on the backs of riots in Greece and all sorts of austerity measures and things like that going in the Eurozone, and yet the US dollar was finding it very difficult to find any legitimate strength or follow through on that. As soon as everything calms down on that front, there's a legitimate chance that the US dollar may weaken here. We have no technical evidence yet that that has begun, but you can see that with that trend line that I drew along the bottom, any quick breakdown to that 73, 73.50 area on the downside would have the US dollar looking over the edge of a cliff again for a potential move as low as the 71 and 70 levels on the downside. Next here I want to take a look at copper futures, and copper had a very nice bullish break higher after that consolidation point at the $4 area. Really at this stage we're right now right in a key overhead resistance level, right in the retracement zone as we speak at this level. It's possible that we see retracing moves back to 420 or even 415 on the downside, but more or less whether copper does another consolidation consolidation or whether it remains bullish here. It will help play a lot on whether the US dollar breaks down. If we see that US dollar breakdown occur down to 73 and then subsequently break lower, copper may in fact make a push right back to its previous highs and maybe even go and gun for the $4.80 to $5 area on the upside. Next year I want to take a look at gold futures, and gold has put in a double top along the upside and is now consolidated down to where its previous lows came in around the 1460, 1470 area. We were always looking for a good test down into the 1420 to 1440 area where all those highs came in previous in 2010 and the first quarter of 2011. But gold doesn't seem to want to make a full breakdown move, particularly if we see US dollar weakness. Gold may rather be doing a far more sideways consolidation than a downwards one. Now, there's not enough evidence that gold has turned bullish yet here, but ultimately, if we see gold hold these support lines and roll up, we could see it trade right back to the top end of its range. I'm taking a far more neutral stance on gold rather than bullish or bearish. When we take a quick look at silver, we've been always looking for this flag on silver to break down and have a move on silver work its way all the way down towards the $26 to $30 area on the downside. But really at this juncture, silver is sort of holding these support lines at the 32-34 level, and it's being supported by the fact that the US dollar is weakening. It is quite possible that this move does not complete itself if the US dollar weakness really persists. If we do, then we could see consolidation lows right along this 32-34, and we wouldn't see that breakdown move occur. If that's the case, it doesn't necessarily again make silver bullish, but it would mean that it could trade right back to the top end of this range, right towards $38, and then kind of wallow in a back and forth trade range for a little while before there's real room for it to turn bullish. Next year I want to take a look at crude oil futures, and essentially we've been looking for this breakdown move to come down towards this 85 to 92 area on the downside. We saw crude oil trade as low as $90, so it has completed the measured move lower. Really at this juncture we are seeing a bounce in crude. There's always room for crude oil to still make one more retest of those lows, maybe come for another solid test of the 90 area, or even make one more push to the downside towards 87 or 85. But overall we think that crude oil will find its lows somewhere down in here, so we're really just looking at how crude oil will bang out its bottom. At some point crude oil will be a buying opportunity here. Finally, I want to take a look at the 30-year Treasury bonds, and essentially we finally got that corrective pattern on the downside that we were looking for on those treasuries. Essentially, the wave of selling came on the back of weak US dollar and strong markets. At this stage, we've come right to an important support line at this 122 to 122.5. This is where we were always anticipating a correction to head down to. Now is the moment of truth. Will we get another bounce in the treasuries right back to the previous highs, or will we see a consolidation flag here that makes a break below the 122 level to begin a far more bearish and ominous scenario for Treasury bonds? A lot of whether the Treasury bonds break down here will be inflationary expectations, which will have a lot to do with whether US dollar breaks down and subsequently commodities have another bullish push higher. Under the circumstances, if we do see very bullish commodities in the second half of the year, Treasury bonds should not only weaken to its lows but potentially may even break to lower lows. So there's a lot of scenarios of that could turn things very sour for the 30-year Treasury bond, but we're not going to overread into that just yet. We're probably going to get a bounce here on the Treasury bonds this week, and the jobs number may be the catalyst for the next leg on this on the bonds. That was your Monday Futures Market Outlook. Thank you for joining me.